Welcome. Today, I've got a returning special guest, Ivana. How you been?
So great to see you, Eric. Been great and very happy to be back here.
We talked last time in February of 2025, so I wanted to invite you back to the channel just to revisit some of those topics. And some of those topics were epic because we had that conversation right before the dip, and me and some of the community members were able to take advantage of some of those names that we talked about, like, for example, Constellation Energy.
When the sell-offs happen, people sell what they own, right? So they will usually sell the highest quality, best alpha ideas they have because that's what they own. So some of these stocks, like the energy trade in particular, the power generation trade in particular, was very interesting because those companies are actually beneficiaries from the tariffs, right? And from the reshoring. So they got hard hit and their fundamentals, even if tariffs were to be more negative, their fundamentals aren't really negatively affected. So those ended up being great entry points. Another one was networking really pulled back hard. I think it's mostly because people own these names without having a lot of conviction and understanding of what networking actually does.
Absolutely. We were prepared for it. We knew with this administration, we would see some tariff drama. We were raising cash beginning of the year. Things kept going higher. It seemed like maybe the wrong decision, but, not selling out, but, raising some cash, 5-10%, getting ready for any possible pullback from tariffs. And then we got it and we took action, and it was a great move. And some of these stocks you've seen, of course, up 100%, 200%, 300% just in 6 months. Some epic moves that aren't typical in the market. So great buying opportunity. And now we're kind of back to the point again where I think with the rates being cut, we probably have some tailwinds where we can go higher. But at the same time, if you wouldn't be surprised either if there were a 5% kind of garden variety sell-off in the NASDAQ tomorrow. But there's a lot of money in the sidelines. I think the trend is still up. And right now it's just bulls on parade. And so it's great for growth investors right now, but we also have to be prudent and diligent. And we want to understand the companies, to your point about conviction, that we own. And that's what we're really big about in Fired Up Wealth, is really understanding what you own. You can't borrow conviction from me. You can't borrow conviction from you. You have to have that conviction yourself. The great thing I love, of course, you run an ETF, SPRX, and we have very similar investing styles. So really I enjoy talking to you, and I'm recording this. I'm going to let everybody else hopefully benefit and learn from it as well. And you guys drop your comments below and join the conversation.
So Eric, as I mentioned, networking is really at the core of where hardware is delivering performance improvements. So if you look at what Nvidia has publicly said, if you look at some of the competitors, what they've publicly said, a lot of where we're going to find innovation in is going to be on the networking side and how these chips interconnect with each other. So that's really one area that I feel like it's misunderstood by the market because a lot of these companies are actually new entrants. Like Astera Labs is a pretty new, relatively new company. So a lot of the products that they're introducing, you really need to dive deeper and understand what they are. It's not like there is publicly available knowledge. So you really need to build the knowledge of this company. So that's been a big focus area for us. I think we're going to continue focusing here. I think there is more to come on the innovation front, but you can see it even from the larger cap like Broadcom. They're able to keep surprising even on a larger revenue base, right? And I think going back to your prior point about rates, I think you do want to skew towards smaller caps here as we get this rate cycle ahead of us. So we've been more focused on smaller caps than traditionally would be. So this is why companies like Credo and Astera Labs and Arista Networks is also relatively smaller. It's not a small company, but this is why they've been such big focus areas for us. They've gone up a lot. They can easily pull back from here. Today, there was some news about the Intel-Nvidia deal being a negative for them. So they're pulling back as we speak. But I think over the long run, they're going to continue to innovate and find new products. And just to give you a sense, like last year, Nvidia was literally like the only customer they had. Right now, as these custom chips are coming to market, as other companies are kind of trying to figure out how to integrate even NVIDIA's chips, their customer base is increasing from just NVIDIA to like 10 customers. So that's really the thesis here for some of these smaller networking plays.
Makes a lot of sense. And I want to thank you because you did help push us over the edge on Astera Labs. And we took advantage of that dip in April, made a lot of money. It was a little bit scary because I think I started buying in the 80s and it dipped down to 46. And there was one point I was overweight in the community portfolio thinking, what am I doing? You know, am I too heavy here? But I had conviction. I did a lot of homework on it. I'd been following it. I generally have a rule where I don't like to buy new IPOs for at least 4, ideally 6 quarters. And if you follow that, I mean, sometimes it works, sometimes it doesn't. I'd say most of the time it works, especially if you look at the IPOs we're getting now, right? In a bull market. I think the difference is, though, last year it wasn't a frothy kind of meme stock mania bull market. We're going to talk more about that a little bit later, but this has been a huge winner for the community. I do have a question on this. So this is one that I recommended on the YouTube channel, Credo Technologies. The reason I never bought it is it's headquartered in the Cayman Islands. And I've been investing for around 30 years and I'm kind of old school. I've got certain disciplines where it's like, if a company's headquartered in Cayman Islands, well, I don't want to invest in it. And it's just kind of a rule. It's a guardrail so I don't drive off the cliff. What are your thoughts on that? Is that a red flag to be warranted, to be considered if it's headquartered in the Cayman Islands, or am I just overthinking it?
I mean, I don't know. We'll find out. You never know. These things can kind of come and bite you down the road. But we see the products, they're real, and the customers are liking their products, right? So at the end of the day, they are generating the revenue. I don't think the numbers are inflated because you can triangulate to the sizes of orders that Astera Labs is getting versus Credo is getting. And they're pretty well positioned on the active electrical cable side. So haven't really seen any red flags related to their headquarters, and I think the numbers are real. So I'm not seeing anything as of right now that would be a red flag.
So looking at these two stocks, you know, Astera Labs made a lot of money on it. It's the #1 position in the community portfolio. I believe it's the heaviest weight in SPRX as well now. Most of that's because
most of it performance driven, right? As we sized it up to like a large position during the pullback, it basically outperformed the rest of the portfolio, even though the rest of the stocks did well too.
Yeah. So the question, I guess, you know, for viewers, they're saying, well, that's great, but I didn't buy those. Can I go buy them right now? And so where do you see these stocks headed from here? For us, we like to trim. For example, we've trimmed back stocks like Astera Labs, and we do what's called house shares, right? So you take your initial investment out, maybe some profit. What you got left is kind of the house share money. You know, if it goes to zero, you still made money, kind of a thing. It's the mindset. It helps with psychology a little bit. And we also portion size our positions just like an ETF. So right now, this is about 9%, which is it's still pretty heavily weighted. We don't want it to be 20% of the portfolio necessarily. For me, I think longer term, a company like ALAB it has huge potential to go higher, but when the stock's just gone from $46 to $260, is it still going to go higher? Or what do you tell a new investor or somebody that hasn't bought the stock yet what they should do?
Well, that's a great question, Eric. So we assess it on an ongoing basis. So like, let's say like right now, post earnings, we're going to do the entire portfolio, new analysis, as though everything is a new idea. And that's when we resize them. And sometimes we can resize things in a pretty significant way if we see that the numbers that they are projecting are already priced in. What I would say specifically to these two stocks is the new products they're introducing are game changers for the numbers, right? So when you do the analysis, like the Scorpio, for example, for Astera Labs, they have been a player in PCA retimers for a long time. That's the majority of their revenue base. So this Scorpio is like equally to a larger revenue size product that's scaling pretty well. So we will revisit kind of the analysis post earnings season to see kind of where it lands compared to other upside in other stocks to decide. But I would say that there was a sizable move in the stocks because a lot of these new products got introduced and they're scaling well and they're just really large as percent of like their current revenue base. I always recommend people to buy dips. That's one like when you see something really underperforming that you really like or have conviction, that's always a good thing to do. That's what we do. So like it's also good to have a combination of things. We do analysis that it's maybe a little bit too technical. where each stock has a momentum factor. So you don't want to be overweight all stocks that are just gone parabolic. You want to balance that out with stocks that have pulled back, if you will. That's kind of the simplest way to explaining. But the way it works is each stock has a momentum factor, and then you want to be balanced between momentum and value. So you would want to be adding to stuff that has pulled back. So within here, for example, in hardware, I would highlight Coherent is a stock. I don't know if you're familiar with them. They had a terrible, I wouldn't say a terrible quarter, but disappointing quarter. Yep. And they are a supplier to Ciena, who had a very good quarter. So clearly there is something to do with expectations rather than the fundamentals not being good. So that's one that we sized up on the pullback. So if people are looking to buy dips, I think that's a good dip to buy.
Coherent. Yeah, we do own that one. I agree. I'm bullish on that. I think there's a lot of opportunity. It's interesting. The CEO is actually highest paid CEO. If you look at that, he's getting paid more than, a lot of big companies that are household names. There is a turnaround story, by the way, there. So I think that's probably why they're usually when a CEO, when they need to do heavy lifting, the company is incentivized to pay up rather than if you're just going somewhere where like you just go with the flow and manage from strength. Yeah. So Coherent is one. In fact, I've done some analysis, some write-ups on that and own it in the community portfolio as well. I am bullish on that. I do agree with those points, especially, last time we talked, we had the conversation about Broadcom and Marvell, and having that conversation is like, well, Marvell's much smaller cap, right? So it has the ability to grow. What's crazy is Broadcom just keeps going higher and higher and higher. Marvell's kind of gone through a tough period here. We had an investor day. We had, I think, something else where they missed a deadline or presentation. They pushed something out. Has your conviction changed on Marvell, or do you still? What are your thoughts on Marvell since February when we talked?
Yeah, so Eric, spot on, and this is a great example actually about how we cut losers. The big red flag came when Marvell moved their AI event date due to market uncertainties. Which, while there were market uncertainties, none of the other companies were moving their date. So that's when it kind of became a red flag. And we had been continuously doing work on it and analyzing like whether they can still deliver returns. And we did not like the latest quarter. So while I think there is still potential, especially I think what's going on is that the first generation Trainium Amazon chip didn't do so well. But the second generation has a potential to do well. And they highlighted this a little bit on their earnings call, but people kind of want to see it to believe it. So this is one example where we had to cut our losses and move on to other ideas that we have higher conviction on. But in the meantime, we're not really stopping doing the work, right? So now we're going to try to talk to people that are familiar with the Trainium 2 model and see whether Anthropic is actually generating good results with it. So we would revisit something like that. It's a bench idea right now, but we don't necessarily need to own it.
Okay, that's great. Yeah, I appreciate that. And before we move on from this hardware piece, I can't not ask this question. So of course, this big announcement, I did a video last night on it, partnership deal, Nvidia investing $5 billion in Intel. So let me guess, you're running out and buying Intel hand over fist now, right? Because you're super bullish on it. I'm being facetious, but what are your thoughts?
Yeah, I think it's going to take a long time. I think it's on a good track. I don't disagree with that. I think the move was in line with the announcement. I don't think it was overdone because it like a lot of I got few calls from reporters. They're like, oh wow, now it's trading at a P multiple that's very high. That's not necessarily a good way to look at Intel just because the earnings have been so beaten up. So it's not necessarily just look at the multiple and say it's expensive. But it does have a lot of issues that need to be worked through, especially on the foundry side. So the chip side, I think it's a little bit easier to fix. And I think this NVIDIA partnership is a step in the right direction. I think the foundry side is really the challenge here. So if they can find a solution for that, it would be a more interesting idea. I don't think it's as easy to turn these technology companies around. It's possible, but it's not as easy. So they're cleaner stories, in my opinion, here. But yeah, I'd love to hear your thoughts. I didn't get a chance to watch your video, but I'm gonna jump right into it after this session.
So, I mean, basically, we agree. Intel is one where the culture, it's been tough, right? It's been a laggard. It really has gotten beat up and didn't really capitalize at all on the AI wave, and it should have, right? And so it's been getting beat up. We've got a new CEO, we've got some new board members, we've got a lot of great things. And I said in the video that, you know, if you're an Intel shareholder, you should be happy with this progress. And there's a lot of great things going on. We're heading the right direction. You got the US government investing in Intel. You got Nvidia investing in Intel. You're seeing all this money come in, but the reality is it's very expensive in the foundry business, and it's very hard to compete with Taiwan Semiconductor. So it's going to take a lot more money, probably another $100 billion, and it's going to take a long time. This isn't a magic wand where it's just like, oh, okay, well, now all of a sudden they can go and create these CPUs for NVIDIA. Yep. This is going to take time. And so you're not going to see any impact at all for a very long time, probably a couple of years. You know, it's not going to be like next quarter is going to impact. But if you look at the x86 architecture we talked about yesterday on the video, essentially, if this came to fruition, it would be a threat to AMD's business because the partnership is both data center CPU, not GPU, but CPU, right? As well as the personal computing space. So if you look at personal computing with ARM, and you've got things like Snapdragon with AI PCs, AMD, most of the revenue from AMD is still coming from CPUs. NVIDIA,
yeah, 100%.
Most use GPUs, right? So if NVIDIA and Intel partner and they start gunning for CPUs, that is a threat to AMD, but it's not going to be something to be concerned about overnight. But if you're an AMD shareholder, I do think you have to keep your hand on the pulse and be aware of what's going on and watch for developments. But I'm not panic selling. I own AMD. I'm not going to go panic sell. I'm not going to go out and buy Intel because of this news. I'm still bullish on Nvidia and AMD, and I still own some Qualcomm in a dividend portfolio. I own Taiwan Semiconductor. That's my take on it, just in a nutshell, you know, really high level. That essentially, it doesn't really change much for Intel, and it also is speculation. It hasn't happened yet, right? So when it actually happens, then we'll know more. But at this point, it's just like, hey, you're heading in the right direction. You're doing some great things, but the proof's in the pudding. And so you say the stock's still expensive. Well, based on metrics, it is, and they're not going to generate a bunch of revenue from this tomorrow, so it's not really going to change that trajectory, right? That's kind of my thoughts.
Yeah, no, I'm completely aligned. I can't see how it's a positive for AMD. There was somebody, by the way, today with a note saying that they actually thought it was going to be a positive because it's going to put x86 in the spotlight, and x86 versus ARM, that's been a big battle. And while Intel and NVIDIA is going to take some time to work out, AMD could kind of benefit in the short run. I don't buy that. I don't know that that's how I read the situation. I would think that this is an incremental negative for a new competitor. Can't be. I mean, there's no way to spin it, right? A new competitor it's hard to be positive for a stock.
A lot of people
we own two AMD, and it's kind of on a watch list right now.
It's become one of those cult kind of names, but a lot of people that own it don't understand. Again, the conviction, not understanding what you own. You know, Nvidia, most of their revenue is coming from GPUs, right? AMD, most of the revenue is coming from CPUs. And the reason that we bought AMD is we consider it best of breed for data center CPUs, but most of the revenue is still coming from PCs at this point, right? So yes, AMD does compete in the GPU space. There's a lot of TAM, so it can take some of those crumbs and it can still do well. It can still take some market share, but NVIDIA is still dominating. And if anything from this news that you should take out of it, Jensen Huang and NVIDIA are doing some power moves the last few days. And I look at this as, so you had the government invest in Intel, and then you had China come out and say, we're going to ban NVIDIA chips. And then you have Jensen saying the next day, by the way, literally the next day, Jensen's like, hey, you want to betray us? That's fine. We're going to go partner with Intel, you know, because this is kind of getting into geopolitics now. And you have to imagine, this is speculation on my part, you have to imagine that Jensen had this conversation with the Trump administration behind closed doors. And I'm not trying to get political, but these are some power moves that you're seeing from Jensen Huang and NVIDIA. And if anything, for anything at all you get from this news, it should be that NVIDIA is still king, and that's not going to change anytime soon. And that's my opinion. Do you agree?
Yeah, no, I agree with that. And while there were some reports that, oh, well, NVIDIA had been looking at this prior to the Trump administration, they've been evaluating Intel. While that may be correct, nothing got announced then, right? And something got announced today. So I'm reading it in a very similar way to you.
Absolutely. That's good stuff. I'm glad we covered those topics. Moving along, we want to talk about data infrastructure. Now, just kind of a recap for viewers. Back in 2023, we came out with a series of videos, best AI stocks to buy. We talked about the different phases of AI. That first phase is going to be that hardware. Phase one, infrastructure, building out data centers. That's what we just talked about down here, right? With the NVIDIAs and the Broadcoms and the Arista networks and all that. Arista is actually interesting too. We could have probably spent some more time, but NVIDIA is making lots of moves to compete in all kinds of different areas, but we'll just move on from that. But part of the reason Arista networks sold off a little bit too is because of some of those competitive concerns. But we talked about phase one infrastructure, the hardware piece, and my view on it back then, and it's changed slightly, but overall, it's still the same. You build the LLMs with the hardware, right? So if we're thinking of generative AI and LLMs are built from data centers, and of course we're getting more into agentic and there's lots that goes into this, but just from that first part back in 2023, over 2.5 years ago, saying there's going to be phase one hardware, which we're still very much in that CapEx spend, and that has not slowed down. It's only accelerated. And from there, if I'm thinking it from the enterprise side, if I'm a Fortune 500 company, now there's these different LLMs that are built using this hardware. And what I want to do is I want to take my data, my enterprise data, and be able to connect that data to these LLMs so that I can use that data more effectively and more efficiently, whether that be internally or customer facing. Palantir with AIP was a huge first mover sort of winner in that space for us. The other names that for me that I've identified, Snowflake, which you have here, as well as MongoDB, which I realize falls in that database, but there is some kind of overlap with data platforms and databases. Of course, you got Cloudflare and Databricks being private. When MongoDB got sold off, we would recommend people buying MongoDB. Of course, it gets scary because it doesn't go up overnight and everything else is going up. And you're thinking, Eric, why did you tell me to buy MongoDB? Well, then all of a sudden has that last earnings report, and then Wall Street's coming out and saying, okay, well, this is actually looking a lot better than we thought, right? But I look at this as phase two, and then we're going to talk the third step, AI applications. And a lot of that, there's overlap with all these, but a lot of these then start to tie into consumer up here with Roblox and Tesla. And I've got a couple questions in that space. So for data infrastructure, you wanted to bring some highlights to the community about earnings and some recent updates. The floor is yours.
Yeah, so I think this is another area in addition to networking that stood out from this earnings season. Pretty much anybody on the platform side reported blowout numbers. And I don't have Oracle here, but that's an interesting potential addition to this list. So Snowflake, very strong growth. Cloudflare, really surprised to the upside as well. Palantir. So I think this part of the layers, I think it's really starting to see the real impact of people trying to access these models, enterprises trying to access these models. Cloudflare is interesting, which is basically allowing new companies that are building new tools. So it's really great for like brand new AI companies. Love their platform because it's much more flexible than the traditional hyperscalers. So I think there's a lot of interesting things going on here, with the most recent one being the Oracle earnings. And I thought that was a very interesting way the way management explained their positioning with they actually have the enterprise data, right? So if there is an easy way that companies can organize their data in these vector databases and then run models on top of that, that could be a pretty significant winner. I think most people for Oracle, they got excited about the big billion-dollar projections. To me, that wasn't as big of a deal because let's see where the projects are, let's secure the financing, right? So a lot of that is kind of like a show me story. But I do think that there is something that may be misunderstood by the street in terms of their positioning with enterprise data and what can be done with the enterprise data. So that's a one to like put on people's radar. Everyone is still pretty negative on it. So I think sentiment, even post this move, people have gotten even more negative on it. But I think it could be interesting to track and put on your watch list in the long run and see where like how much they can deliver, right? A lot of it does depend on them, similar to Intel, right? Like it's not a clean winner. It's a bit of a show me story, but if they can show some progress, I think it could be interesting.
Absolutely. So Oracle is one that we were buying. It was a recommendation, 150 or less DCA. And this is an interesting one because I worked for Oracle for a couple of years and then went into the partner ecosystem. For about a decade, I was with the Oracle ecosystem. And so that company looks completely different now than it did, but I do understand the company and its culture and leadership. And it's funny because I had a bunch of shares back in the day, you know, employee share and stock options and things. I ended up selling a lot of that. And now I was buying it back in April, 150 or less DCA. And it's funny when that ripped 33% or whatever in one trading day, I certainly was not expecting that, but I was very happy because it was like another one where, you know, you got in, you saw some stuff, you saw some good things happening. It seems like the market didn't really care. And then all of a sudden it takes off. And that feels good when you put in the work and it actually comes to fruition. I would love to hear your thoughts on this though, because, and you kind of, you mentioned this a little bit. And before we hit record, you mentioned how you posted something on X and there was a lot of negativity. So what are your thoughts on Oracle? Is it something where institutions just aren't heavy enough on it and that's where they're mad? Or is it something where, you know, they don't like it because now the cash flow and the cash burn, or where is all this money going to come from? You know, all this money coming, this backlog of billions of dollars, hundreds of billions of dollars. Is that really going to come to fruition with things like OpenAI, with Stargate? What are your overall thoughts on all that?
Well, I think it's interesting, right? Because I think the CEO is a little bit, or actually the management team overall is a little bit overly promotional. So I think that's kind of like putting a little bit of skepticism in people's mind because they put out these $1 billion revenue projections, right? But then people are asking questions. Well, have you secured the land? Have you? Right. So I get the criticism. I don't think it's completely wrong. I think people are just underweight this, right? So I don't think it's in any institutional, like real kind of like smart money type portfolios. And the reason is because I think people have this perception that investing in the heavy CapEx places is not really going to be where you get the best returns. And I completely agree with that perspective. Like, I think if you look at this value chain here, really the returns are made by the asset light business models like Nvidia. Like they didn't have to invest billions of dollars in CapEx. So the returns will generally be better on the asset light side. Now, what I thought was interesting on the earnings call is that Oracle described their investments as not asset light, but asset pretty light. And that's a quote. So I thought that was interesting because I think if they can somehow invest while not owning the actual physical data centers and really only invest where they can add value and make it an asset light type investment, I think there could be pretty decent returns. So to my prior point, the key for them is whether enterprises that are already on the Oracle platform will choose to use directly AI models from the Oracle platform. And I'd love to get your thoughts on whether, because that sounds great on paper, right? But it's another question of like, is that really realistic and will companies really do that? So I'd love to hear your thoughts on that. But I think it does sound very intriguing here with people being so underweighted even post the move.
Well, it's really interesting about Oracle, right? If you go way back in history, it started out as, you know, it's hardware, really database. You have database here. So Oracle database, I'm getting messy here. Let me start over. So you got Oracle right here. And we're talking about data platforms right now. But if you think about the history of the company, it's database. In fact, MongoDB, you know, the reason you would own it is it's disrupting the Oracle traditional SQL database. Now, Oracle also has bought Sun Microsystems and things in hardware. Now, this hardware is specific to AI data centers, so not necessarily. But what's interesting is that Oracle also has cloud services. So if you like cloud service providers, it's not the one that comes up first. It's kind of like Cloudflare, right? Cloudflare is not one you think of. Even Salesforce CRM, you could put in this bucket here. You also have data platforms, and you got OCI. You also have enterprise, because if you look at enterprise software, right? So when you think of a ServiceNow, you think of Salesforce. Mark Benioff came from Oracle, started Salesforce, one of the first SaaS companies in 1999. Oracle really fits in a lot of these different categories. And so a lot of people don't understand that it's not, people think a long time ago, they think of it as just as a database company, or they think of it as on-prem, or they're thinking of this or that. They've acquired so many different companies, PeopleSoft being one of those big acquisitions that was super controversial back in the day. If you look at their model for growth, it's been M&A, and just most of it wasn't organic. When you have a lot of M&A like that, and you're taking a bunch of companies and jamming them together, like Sun Microsystems and PeopleSoft and all these, even when I worked there were employees that were disgruntled because, they loved PeopleSoft. They didn't like working at Oracle. Some of the customers, didn't like it because they're kind of forced into Oracle because it was a one throat to choke. And so Oracle's doing all these different things for these companies, right? Because they can do all these different areas, and it's one throat to choke. And so your question's kind of like, well, they actually use Oracle. They have so many customers already, and they've got relationships already. And so I think it's definitely feasible that Oracle can kind of do whatever it wants to do. It has those roots in Silicon Valley. You think about the company, it's been around for quite a while. In fact, I was just going to look this up to see the year founded, because I don't want to say the wrong year, but it's been a long time. Oracle, 1977, Santa Clara.
Wow. I would have guessed the 80s.
And this would have been, one of those .com bubble type companies, Oracle, right? So Larry Ellison, of course, he's in his 80s now. He's friend and mentor to Elon Musk. He took over as the world's richest person for a few hours and then lost it back to Elon Musk. Definitely has deep ties, and even Safra Catz and that leadership team. The company's changed a lot. They've moved a lot of their operations to Texas within a lot of their sales groups and things like that. And they've got different areas all over the place. But it's a very large company. It has a lot of employees. It has a lot of clout. It has a lot of connections, very deep rooted relationships. So I wouldn't count Oracle out really for anything, if that answers your question.
Yeah, and the other thing I'd point out, Eric, is that we are hearing with AI, that many enterprises may actually prefer to stay on-prem, right? So they may not want to share their data in the cloud, and then who knows how it's being used and like what models are being trained on. So I think that's a question that we've been trying to investigate a little further, in that there's obviously so many companies that even if a small percent decides to go on premise, it doesn't mean that the cloud businesses are dead, right? But there is definitely something to be said about if you have a business that is very sensitive in terms of data sharing, and whether you'd want that to be in the cloud.
Yeah, I mean, the big players there, Oracle and SAP, right? Those are going to be the two, red and blue. So I mean, Oracle, what's great about Oracle is they can do both. They can do cloud, they can do on-prem still, they can do hybrid. Yep. So that, they're very versatile. I'm not trying to overhype Oracle.
Yeah, exactly. Same here. It's not a large position for us at all. It's just something that's interesting to follow up on post earnings. That's usually what we do. We have a bunch of questions, and we will dig deeper into them.
Absolutely. Yeah. I mean, for me, it was about the valuation and the fact that they were doing a lot of exciting things. It's now over $300. I mean, a recommendation was 150 or less. I mean, it's 100% higher.
You really need to believe in a transformation here for it to make sense. It's not steady as you go, right?
Yeah. I mean, at 150, I thought it was solid. At 300, I'm a little bit more hesitant. I agree with what you're saying. And it's
Oh, by the way, one thing I did want to point out in this data infrastructure layer is the cybersecurity stocks have pulled back a little bit here, and they look very attractive because they really benefit from AI, both on the fact that AI agents now can be cybersecurity based. So companies like CrowdStrike, they're launching cybersecurity AI agents. So instead of you employing an entire cybersecurity team, you may be able to have like one CISO with a bunch of AI agents. And then the other side that's interesting is that with the growth of AI agents, not cybersecurity ones, but just like browser agents and sales agents, those need to be secured. So companies like Palo Alto are doing really well. And Zscaler is another one that's really trying to tap into that market because they are already sitting on tons of data. So they would be the go-to to protect these AI agents from like not doing things that you don't want them to be doing. And a lot of them have pulled back. Palo Alto pulled back because of the deal. I think the deal is going to end up being really good for them. I think the CEO is really good at execution. CrowdStrike, same thing, pulled back because of like just market concerns. So I think after this pullback, this area looks pretty interesting. There's another one that's not on this list. That's a recent IPO. So I don't know if it's going to be a good fit for you because of your rule with IPOs, but it's Rubrik. And that one sold off as well on earnings, while the earnings were actually pretty solid. So there's a lot going on in the cyberspace that's interesting and worth highlighting.
A couple hundred people just stood up and started clapping when you said Rubrik, because that's one we've been buying heavy here recently, and it's had
is that right? Yeah, me too.
nice pop in the last couple of days. And in fact, there was just a comment in Discord: I should have bought more Rubrik. You never know; it could come back down. But
yeah, and with rates, with rates kind of being capped here and going lower, software really got hit with rates, and cybersecurity participated in that carnage that occurred in 22. So I think this is an area that could really benefit from that interest rate tailwind, more so than the hardware layer would.
Yeah. We got our 4 earnings reports, so it did meet the requirements there, and I've been following it the whole time and pulled the trigger. That's a recent recommendation on the channel. Of course, we can't give financial advice. Palo Alto, you mentioned about AI agents, and they're buying CyberArk, $25 billion. That's a big number, right? But I think one of the main reasons is because of this AI agents. That's going to give them additional capabilities with Palo Alto, which is why we also bought Palo Alto on this recent dip when it was about 10-15% lower than I think it is now. And then CrowdStrike, we had our Falcon this week, as well as guidance increase, 13% pop yesterday in one day, which is a pretty big move for CrowdStrike off of something like that. So these are fired up all favorites in here that we've owned for years, since the IPO with a lot of these. This one I haven't been as bullish on. We do own a small position in the community portfolio. Microsoft since 2012. Palo Alto is a new position here on this recent sell-off. And then, of course, that Rubrik RBRK that we just added here in the last, a couple weeks. So these are great names as well. Good stuff. I appreciate the insight. It's really fun catching up, and hopefully everybody that's watching is learning something and enjoying themselves as well. The next topic, and before we do that, I think what might be good is to talk about, this is the enterprise piece, but I wanted to talk a little bit about, I had somebody today a comment about, hey, I brought up Open Door to you, a few months ago, and you kind of shrugged me off, and it's up 300%. Kind of, I almost felt like throwing shade. And something that we talked about before we record, this is the stock market. You're in a bull market, and there are a lot of stocks that do some crazy moves. A thing like Open Door, that didn't necessarily happen off of anything fundamental. It's just a lot of trading momentum, and that's going to happen. You're going to get certain names, especially, since the pandemic, we've had that kind of retail mania, and there's nothing wrong with it. Not talking bad. I'm a retail investor myself. But you see a lot of these names that get hyped to the moon, and people buy them. They don't really know what they are. I'm even seeing some of these stocks. I won't mention any names necessarily, but there are a few that I know that community members know exactly what I'm talking about, where they're $5 billion and $15 billion market caps, and they have zero revenue, none. And I'd like to get your thoughts on some of this. I'm calling it Meme Mania 3.0. I think people have to be careful. Number one, I like to invest in secular trends, just like you do, that fit my blueprint, that fit my DNA. And so if you come to me with an idea that's, say, open door, and I'm not, investing in real estate, I don't think real estate's a secular growth trend in technology, right? Necessarily. Just because the stock goes up 300%, there's going to be a ton of names that go up a lot, and you're not going to be able to own every one. You mentioned earlier about only having so many stocks that you can pay attention to and things. What would your message be for some of these newer investors that are FOMO chasing some insane valuations and just a lot of meme mania out there? Do you have any thoughts on that? Any wisdom?
Yeah, absolutely, Eric. I mean, really, the way we deliver returns is by sticking to our knittings. So I couldn't agree more with you that really people should narrow down what they want to be researching and doing work on, and really sticking to that, because that's how you're going to generate the best returns. If that's open door or real estate, nothing wrong with that, right? So if you've done the work and you have a proprietary way to generate ideas in that space, there's nothing wrong with the real estate space per se. But the way you generate returns, it's not by what you missed, but what you own. And it's so important to have conviction in what you own, because when you have sell-offs like April, you will have no problem adding, right? Imagine if open door is down 150% tomorrow. Will you have conviction adding, right? So that's really where staying focused on what you understand comes in play, because really the returns you're not going to generate by chasing stuff that your neighbor owns. It's really going to come more about like investing in what you own for the long term. So I agree with you. There's definitely like a bit of a retail mania going on, and it's not necessarily, some of these will end up being successful companies and some of them won't, right? So the question is going to be then, if you look at that universe, what percent actually ends up making it, right? And you don't want to have basically a broad exposure to that. So to your point, I really think people should stick to their knittings and like identify an area that they want to be invested in, learn more about it, and stick with it through downturns.
Yeah, because if you look at the most popular names that were kind of meme type names, and meme is one of those terms I think people look at it condescending. I mean, I've said this many times. I own Palantir, and it's a good company, but at an 83x EV revenue and a cult following, it starts to cross the line a little bit. You could call it a cult stock if it makes you feel better. But
yep.
Meme cult, whatever, momentum names, they all kind of overlap a little bit, right? But when you look at 2021 and we look at the fallout, how many of those most popular names made you money 5 years later? Not very many.
Yeah, and the other thing, Eric, that I would point out is that what ends up happening is when we have a big sell-off, everything sells off. So all of these are going to get crushed. And then the moment things stabilize, investors don't go back into them because nobody has conviction, right? But they will go into the riskier, like Astera Labs or that type of a company where like they had conviction, they just were forced to sell. So you really want to invest in the ones where if they get hit, institutional investors are going to buy them the first moment that the market stabilizes, rather than kind of hoping that there is one day that they will work.
That's a good point. And it's kind of that line in the sand where it's hyper growth with quality, like Astera Labs would fit that in my opinion as well, versus something that doesn't really have fundamentals. It's just a bunch of people want to trade it. And that's fine, right? At the end of the day, the stock market's there. You can do what you want with it. It's your money, right? And we need liquidity. So you can have day traders, you can have traders. I'm not dunking on anybody, but don't come to me with something that's out of my wheelhouse and be like, why don't you own that? Hey, Ivana, this biotech company went up 1,000% last month. Why the hell didn't you own it? Well, it's because it's not what we're focused on. Like, you can go read what I'm focused on. My blueprint is the same kind of thing. It's like kind of like building your own ETF, and you're focused on these areas that you can capitalize on. It's a little bit different mindset because I'm not trying to necessarily actively trade it as much, maybe, but I am still going to sell a stock if I lose conviction, if the story changes. It's buy and hold for 5 years unless the story changes. Well, the story changing could be growth accelerating to the point where it's like, well, my money might be served elsewhere, right? So I just think that it's really dangerous, and it's hard for these new investors that come in, and there are great sites and YouTube channels, like, in my opinion, this one, of course I'm biased, but that's trying to bring you value and education not just trying to pump the flavor of the day. And of course, with anything, there's always going to be those flavor of the day channels, and that's fine. Let them do their thing. But I just don't mix the two together. I mean, we're trying to invest. When we buy stocks, we own part of the business. We're putting research into that. We're understanding it. We've got some rules of engagement that we're following. And that's okay if you want to do whatever you want with your money. If you want to do YOLO naked calls and try to get rich quick and turn $5 into 5 million, you can do that because it's a free country and it's your money. But
yeah, I would say though, Eric, like the one thing that young people especially don't value is the power of compounding, right? Time passes so much. People have so many years ahead. Even now, people are living so much longer, right? If you can generate double-digit returns, like high teens, you're going to be doubling your money every 5 years. You don't need 300% returners to do that, right? So it's much more important to stick with what you know and generate consistent returns over time than losing all your money during a downturn and then not having a way to compound out of that.
Absolutely. And we talked about this on the last time we met about, alpha is important in making money, but also saving money and not losing all of it. Because if your portfolio goes down 70% in a bear market, it's going to take you a long time to crawl out. And there are still people from 2021 that haven't done that because they went all into Uber spec alpha type stuff and not anything with real solid fundamentals.
Yeah.
So there's a fine line between just buying anything because you think it's going to go higher and buying something because you believe that there is a secular trend, that there's going to, you have a vision of what CapEx might look, AI might look like, or it could be robo-taxis, or it could be whatever the hell. It could be, you could even have a bull thesis on flying cars, but then I want you to understand that it's very difficult to take a prototype and make it scalable. It's 100 times harder, as Elon Musk says, and not only to scale it from manufacturing capabilities, but you would agree with this, and I'd like your take on it. We've been talking a lot about adoption curves for technology, and a lot of new investors get confused, like, oh, hey, I like that idea, a flying car. Well, flying cars are going to take a long time. It's going to take a lot of money. You're also going to have a lot of if you think of government rules and regulations, right? So, you know what I'm saying? And then to actually scale it and make it profitable, I mean, manufacturing anything, if it's a car, a vehicle, even it's a TV, the margin profile is a lot different than like a software as a service thing. And it's just very difficult. So it might be really exciting as a new investor, young investor. I'm going to buy the next NVIDIA. It's going to be this flying taxi idea, and it could work out, but do you understand? Do you have the business pedigree to understand how really hard that is? If it works out, it could be a 10x or a 20x, but the chances are it's probably going to be worth nothing because their cash burn is, way more money than they can ever bring in. And it's a cool idea, but it's just very, very hard. Even if it came to fruition, the margin profiles are so low that my money's probably served better elsewhere, where I know like to your point, I can make 15% returns versus trying to swing for the fences. If I'm playing baseball and every time I get up to bat, I'm just trying to hit it out of the park, I mean, that's not going to work out very well because you have to take what the pitcher gives you, right? I mean, so am I making sense? I think.
Yeah, 100%. 100%. I think a lot of these businesses are very difficult, right? Like to your point with flying cars, right? There's going to be that's going to be a very CapEx heavy business. So you're going to be getting diluted round after round, right? Because they do need to raise the money if they want to produce them at scale. And it's actually a very interesting area to track, not just the flying cars, but more broadly robotics.
Yeah.
It's going to be a very interesting investment opportunity, but it does come with a lot of this risk that you mentioned, that it's not that easy to bring physical things, nowhere near as easy as bringing software applications or leveraging existing technologies into something else. And that's usually where you generate the return. So like, even if you look at NVIDIA, the way they really killed it here is because they already had the technology with the GPUs, and then it just ended up working so well for AI, right? So the parallel computing, they did have to invest quite a bit to improve it and make it better, from like Hopper to Rubin and Blackwell, right? But it's really like the best returns you generate when you take something existing and you find a massive use case for it. So that's been in our, for sure in our experience, rather than these new ideas where like, okay, it sounds cool, but then are you actually going to see any return on that, right? If you invest. And the last thing I would say is that if you're going to go for these speculative investments, make sure they're not like 100% of your portfolio, right? So it's okay to be like, okay, 5 to 10% of my portfolio, I will take a chance here, but because I do think it's cool or whatnot. But you don't want to put your entire portfolio into that and miss out on compounding for the next several years.
That's exactly what we teach. Methodology, 5 to 10%, depending on how risky you are. But even if you're high risk, we say 10% max spec, and try to have more than just one of those spec stocks too, right? You want to have a handful of them because the hit rate's pretty low,
Yep.
Peter Lynch, if I'm right 6 out of 10 times, I'm happy. Well, you're a value investor. How many times you can be right when you're buying spec stocks when they have $10 billion valuations and they literally have no revenue and they're burning cash?
Yep.
My plumber down the road makes more money last quarter than some of these companies with $5 and $10 billion valuations. And I get it. It's, you get caught up in the excitement of like, I'm going to have this next big winner and it's going to be this next big thing. But it's hard if you don't understand all these different things. And so I at least want to bring it to you. And if you decide to go buy it, it's your money. But hopefully we can help you avoid some of those pitfalls. You don't put 100% into spec stocks in your portfolio, do 5, 10%. I know we're kind of getting to the point here where we want to start wrapping up, but there's one thing that we wanted to cover really fast. So the last thing that we wanted to talk about, I think you wanted to update us on earnings for enterprise under AI applications.
Yeah, so no, I was going to make the point that in enterprise, it's become very tricky to find opportunities. And this is because a lot of the companies are coming up with interesting AI agents, AI products, applications, but they're really not reaching scale to a point where it's moving the needle for the fundamentals. So it's become a really tricky area to invest. And a lot of it, I think if you want to be invested here, you really need to have an edge and understand where you are different than the street. So a lot of these companies have lagged this year because of that, because they just haven't been able to deliver above investors' expectations.
Yeah. So just curious, this is one that we were buying recently, a little bit lower prices. I think you own that, right? I was just trying to look. You own that one right now, GitLab?
No, don't.
You don't own that one? Okay. Any thoughts on?
We sized down our exposure to AI applications pretty significantly during when we were trying to make room for some of the networking plays and some of the power gen plays. So this kind of set of companies have pretty decent upside, but also not great downside protection.
Yeah.
In our analysis. Now that can change, right? Like as they scale their AI businesses, that can change. But a lot of people are wondering now, where do I really need GitLab? Or even people are wondering, like, do I need Salesforce, right? Can there be a different tool? Can you have a tool that is within the Oracle cloud that is a Salesforce tool per se, right? So I think that's where the big debates are coming. I think ultimately the answer is going to be that yes, you do need it. And even if you have AI disruptors, like they're going to have to keep up. They're going to be able to keep up with them likely because they do have the know-how and experience. But it is a little tricky here in this bucket. And I'd love to hear if you disagree and if you have any view on something that's really doing something differentiated that's not going to be disrupted by AI.
Well, ServiceNow, I've owned this one for a number of years, and I'm more of I like to buy and hold and monitor, and this has done well for me. And it's just, it's just one that I have, I'm up on, and I'm happy owning some of it. We talked about earlier AI agents, and I think that there's a decent play here. Shopify, I actually really like this company longer term, not necessarily as an AI play, just as
we do own Shopify. Yep.
Okay.
It is actually an AI play. I think that they do have like so much data, and nobody that I've seen is coming after them.
Yeah, what I'm saying is that I didn't buy it originally as an AI play. I've owned it for years, and so
yep. Yeah, same with us.
this one, of course, is private, right?
Mm-hmm.
GitLab, I just think it's undervalued. And I think the stock's going to $70. You said it had decent upside protection, not downside. That's probably true. I actually researched this, and this is kind of the area I live in a lot of these, because I used to sell AI application or software, enterprise software, not AI application necessarily. But I do see upside in this. And I just think when I'm looking at, I try to buy stocks that I think are, like we were talking earlier, it's not value investing, but it's growth investing where I think they're undervalued. And GitLab recently, it has actually popped nicely, I think 10-15% since recent buys. But I do think the stock has upside. I could show you a chart and stuff, but I'm thinking $70. I don't own this one. I'm not a big fan of this one. A lot of people have been buying it, saying it's cheap. I'm not so sure.
Yes, that could be a total value trap, right? Like, so that's to our prior discussion. If your portfolio is all Adobes and you're hoping for a pop, right, then you are going to be very low on momentum factors, right?
Yes.
So
this has no momentum, and you're kind of you're trying to bargain shop. You're bottom feeding, and bottom feeding generally, if you put all your portfolio in it, your portfolio is going to underperform.
Exactly.
You can though find some bottom feeders if you have really high conviction. You just think the market's wrong, and they can be big winners. You can make big money on it. For me, this isn't like a buy and hold. This is just one I think. If I look at it a year from now, I think it'll be higher. I'm going to probably, sell it, make profits. And maybe I'm wrong, but this is one, if you look at AI adoption and some of the things they're doing, I actually really like GitLab. I encourage people to dig into it, make their own decision on it. Salesforce is one I've been telling the community for a while that it's a difficult one because the growth just isn't really there. And that's part of the problem. Now it pays a dividend. We talked about that growth cycle. This is a very mature business. It was founded in 1999, and it certainly has opportunity when you think of the AI space, but it hasn't proven that yet. And that's kind of the problem with several of these names. But I do actually own some Salesforce. I've had it for a while, and I remember I did in 2019. Way back when I started the YouTube channel, I did a top 5 cloud stocks to buy. And at that point, it was before AI was big, and it was kind of more focused on like cloud service, like these kind of names. Salesforce was on there, and it's a huge laggard compared to the rest of them, and so that stock it's been under pressure for quite some time. Sentiment, as you know, is a big play too. And just a lot of people don't like the CEO from my experience and my research. So, but I'm not a huge buyer of this currently, in my opinion. Not really a big fan of this, and like we own some of these other names. And I think GitLab's the one that sticks out to me. Microsoft have owned it since 2012, been a buy and hold since 13 years on that one, just letting it compound. But anyway, yeah, that's my thoughts on that group. I think most of your money wants to be, down here, like we talked about earlier, though.
Yep.
Most of the money, not most of the money, but a lot of the money's been made in this area already. Not saying they can't go up, but if you're early, you made a ton of money. I still think there's upside on these. Palantir kind of ripped ahead of everything else, but I still think there's upside on names like Snowflake, even MongoDB. Confluent's one that's just been, beat down. Sentiment's bad. It needs to prove itself. Every earnings, you're like, this is the earnings, and it just doesn't come through.
Yeah, exactly. Yeah, this is another one where like we moved on and took a thesis changer, and yeah, it's basically not worth still you can still keep evaluating it, but yeah, like if they're not delivering, it's going to be very difficult to reverse, right? Same thing with Sentinel-1. We owned that at some point. The thesis was great. It just didn't play out, right? Like they had a chance to really step it up and gain market share from CrowdStrike, and they didn't end up doing it, right? So a lot of it goes into like, you don't want to be holding some of these things that are constantly trying to deliver, and it always seems like they're a quarter away.
And that's the problem. I think people that have kind of that value investing, quantitative mindset, and you see this with, like, I say this all the time, accountants. It's hard for accountants a lot of times to be really good at stock picking and growth because they're very black and white. Not all of them, so I'm not trying to, but if you're very much a quantitative, accountants, black and white, you're not even going to be focused on a lot of these stocks anyway. But like, say a person like that tries to go into growth investing, like they've been investing in blue chip dividend stocks for years, and they're like, you know what, I'm going to get into this growth investing. Everybody's making a lot more money than me. They're going to start focusing on, like an Adobe would stick out.
Yeah. Same thing. Sentinel-1 trades at a ridiculously lower multiple compared to the rest of the cybersecurity names.
Right.
but there is a reason for it, right? And unless they do something, it's not going to magically just become expensive. So a lot of the show me stories, like they actually need to show something that is different than what they've been doing before. So yeah, so to the point you brought up, there's real risk in chasing momentum names, right? There's also real risk in like sticking with value names if you don't have like a high conviction that they're going to turn around.
Yep, absolutely, 100%. Because I remember back 2019, 2020, you can go back and look at some old videos on the channel. You know, CrowdStrike is one I bought 2019 IPO. Was big on this. Big George Kurtz fan. And people would, you know, of course, the next thing comes out and this comes out and they're going to destroy CrowdStrike. This is the next best thing. And it's like, well, they're focused on S&B and these guys have Fortune 1000. And it's like, no, this is the stock to own. This is best of breed. I'm doing my John Madden here. But this has been a dog. And I often have to go back and say, I told you so. You know, if you're buying one, this is the one to buy. And this is still the leader when you think of endpoint security. And it's still my favorite cybersecurity name. That's just my opinion. You can do whatever you guys want with your money, whoever's watching. But yeah, at a certain point, it's a slippery slope between, you know, hey, I'm a long-term investor and I'm going to give this, you know, some time to marinate, because you don't want to sell things too fast. But at a certain time too, it's like you have to kind of just throw in the towel and say, this isn't doing it for me. I've held this for 4 years and it's given me no returns. And I bought this thing in April and it went up 300%. But you also have to be careful of that's a fine balance too, because then you start throwing all your money into these when you're late on it. And then some of these can pop. And like a Palo Alto, you know, this was on sale recently. And so it can be very complicated. It's new investors watching this. It's just the biggest thing I think that both of us would recommend is you have to have conviction, and you can't borrow it from me and you can't borrow it from Ivana. You have to have it yourself and understand it. So consumer, this is final thoughts on this. Anything here? Unity is one that the stock has actually been doing well, but I don't know if it's fundamentally driven or more just like people looking for an excuse to buy something. You know?
Yeah, this area has been pretty tricky, especially from the AI side. I think there hasn't been a ton of, like, to your point, it's either low conviction and large pops, and not a lot of like fundamental support. And we, by the way, we focus more on the enterprise side. That's kind of our bread and butter with B2B technology. So if there is something that is a crossover from consumer, like Tesla would be an example, we would be interested in it. But I think for the most part, a lot of our differentiation is on the enterprise and B2B side.
Yep. That's our focus too. Although we did make quite a bit of money on this one. This one wasn't so good. But yeah, I've been telling people this entire time with AI, the focus is enterprise. You know, the B2C side of it, the money at scale is when you can get these enterprise licenses and sell to 1,000 people or 10,000 people or 100,000 people at a time, not selling, you know, $199 subscriptions to individuals for ChatGPT. You know, it's just that's not where my focus area is either. And
you know what, Eric? Like, I think the consumer space is very large. So from that perspective, it's interesting, right? But on the flip side, people change a lot quicker than enterprises. So that's one thing that we don't love about the consumer, right? Where all of a sudden everybody wants ChatGPT, and then next thing you know, like, people have moved on to something else. And a lot of the consumer names, like, remember everybody was like, oh my God, Peloton is the future. Okay, no, Peloton is not the future. So it's a lot trickier to invest, at least from my perspective as somebody that doesn't cover consumer, versus like in enterprises, it's like once you're like spec'd in or deployed across an organization, there's no changing, right? So in worst case scenario, you stall and your stock doesn't go anywhere, but you're not going to just not exist, right? And it takes like a long time for somebody to become irrelevant. You really need to have quite a few things going wrong for you, versus on the consumer side, like you have one like bad choice of a representative and all of a sudden like you go out of style. So that's one benefit to B2B, I feel like.
Yeah, consumers are fickle, to your point. And then, you know, for example, you have one person, right? So you have to convince them to pay a $200 subscription to your ChatGPT, which is great. And there's lots of people, millions of people that'll sign up for it. But to your point, it's just like restaurants are so hard, because it's like the restaurant of the day that's really cool and popular now, in 5 years it's something else.
Yep.
And you see these trends, and they're very fast moving trends. And people, you look at consumer apparel like Lululemons and the Nikes, and there's like, On, and there's all these new companies that come out and hookahs. That changes, but it's very hard, to your point. And it's the replacement cost is my point, what I was going to get at. If you've got something implemented, right? So I used to sell software, you'd implement it, you'd customize it. It's very expensive to rip and replace technology in enterprise level versus just like you're going to click a button and cancel your subscription,
Yep.
So it's a very, it's much stickier. It's much easier to scale it with enterprise. There's just more money. It's where I want to be with most of my money. And I've been telling that people for years, and people question it often, actually. So I'm glad that you bring it up to help kind of, educate them on some of the reasons why. But this has been great. And like always, we could talk for hours, but I want to respect your time because I've already gone over that and my voice is starting to chop out anyway. Anything you want to finish up on before we go?
Nope, I think that was great. I love seeing you. I would say for disclosure purposes, all of our holdings are disclosed on our website. If people want to check them out real time, they're updated daily. And yeah, same as the prospectus for SPRX is posted on the website as well.
And to be clear, there is no sponsorship with this. It's just Ivana and I having a conversation. I do own some, full disclosure, I own some Spear Alpha ETF, SPRX, but I'm not paid to tell you to go buy it, but definitely explore it if you're interested in some of these names, especially if you want exposure to some of this momentum and maybe just, don't like to have as much risk in your portfolio. If you're one of those type of investors, it's a great way to kind of play that and let her do some of that heavy lifting for you and her team. So
yeah, and this is not a recommendation, right, to buy any security or whether it's Spear or any of the other ones. It's just us sharing our knowledge. So
yep, no financial advice, no payment, just two friends talking about stocks, and hopefully it was entertaining and educational. So thanks very much for your time, Ivana. Until next time, have a great rest of your day.
Thank you.
Later.